I'm Hillary Hendershot, your host, and this is Profit Boss Radio, episode 85. Profit Boss Radio is your weekly wealth mastermind. Profit Boss is also a community and a movement for women who are ready to take control of their money, break the glass ceiling, and give ourselves permission to finally have enough. Want the secrets of wealth to be yours? This is the place. I'm Hillary Hendershot. I'm a certified financial planner running a leading advisory firm for women, and I'm sharing with you real stories from real life and real women who are making it happen. Forget Wall Street. Let's do this, ladies. Do you want to increase your wealth by $50,000 in the next 2 years? Of course you do. Just imagine the peace of mind. Imagine the freedom and security. As successful women, we want to see our work translate to living the life we want. The reality is, too many of us feel trapped by our finances. If you struggle to experience true peace of mind when it comes to your finances, if you're an entrepreneur and you feel tied to your business because cash flow is unpredictable, if you want better control of your money, but right now you doubt your ability to handle wealth responsibly, your reality can start to change right now. What if I could show you how to begin experiencing sustainable growth in your financial life in the next 7 months? Imagine being informed, confident, and in total control of your finances through a proven financial automation system. Imagine creating financial security and growing your net worth. If you're ready to ignite your wealth building future, you may be a candidate for my 50K Wealth Multiplier experience. I'm opening a cohort of this program in January of 2018, and the opportunity is only open to a select group of applicants. If I take you on, it's because I believe I can show you how to create a $50,000 difference in your net worth in 24 months' time. I'm going to ask you to work, though. This program has a community element, so I'll ask you to meet with me and the other women in your cohort in San Jose, California, 3 times over the 7-month program. You get 7 one-on-one coaching calls with me, 7 calls with my team to organize your finances and make sure you're staying on track, and we will be there with you, supporting you every step of the way. Together, we're going to transform everything about your financial life, the way you talk about money, the way you think about money, the way you handle money, and the way you grow your money. It's immersive. We're also going to open up your bank accounts and set up my proven automation system. And then my team and I are there for you throughout the program and beyond if you choose to make sure the plan is working for you. The first step is to apply. You can find the link at 50kwealthmultiplier.com. That's the number 50, the letter K, and wealthmultiplier.com. Once again, 50kwealthmultiplier.com. You should know that no results are guaranteed. Just like any coaching program, you have to take new actions to produce results. I'll be looking forward to receiving your application for the 50K Wealth Multiplier experience. Juicy topic today. Well, I don't know if it's juicy, but it's really important, and I get lots of questions on it, and you are going to be glad that you listened to this episode because it is a complete guide to life insurance. Everything you ever wanted to know. Didn't you want to know about life insurance? If you have kids, if there are people counting on you, if you want to leave people assets after you die, you want to listen to this episode. Specifically, the people who have a soft spot in my heart are the ones who have kids. You folks need to have life insurance. So listen up and we'll tell you what kind you need, maybe how many years you should buy the life insurance for, how long you should have life insurance, and how to move forward. So I got a bunch of questions from you in the Profit Boss Facebook group about life insurance, and I had this amazing interview with Mark Maurer, who is the CEO of a life insurance sort of company, brokerage. I'm going to explain that to you. And I think I'm going to air the interview first. I've decided to air the interview first because I think it's a great conversation about the details of life insurance, and Mark is obviously very qualified to talk about it. And then after the interview, I will come in and answer your life insurance questions. So let's talk about Mark's company. It's kind of a funky name. His company is called Low Load
insurance services. So have you heard of front loads or back end loads on a mutual fund? That means there's a charge to get in and a charge to get out. I think that's why it was his mother who founded the company, named the company Low Load Life Insurance. So let me back up even a little bit more. From the perspective of a fee-only advisor like me, a fiduciary advisor, what happens when a client says, or you say to a client, you need life insurance, you have a specific idea in mind of what kind of insurance they need. In probably 4 cases out of 5, it's term insurance. There's just a finite period of time when that client needs life insurance, and they don't need a whole or permanent life insurance policy. If you don't know those terms, don't worry, we'll define them. And then what would happen is they would go to their property and casualty insurance agent and they would get sold a whole life policy because that person makes a lot of money to sell the whole life policy. And it was very frustrating to not be able to enact the advice that you're giving to clients. So this woman, Judith Maurer, in 1998, founded Low Load Life Insurance. Mark Maurer, my interview today, is her son. He's a certified financial planner with an MBA, and he took the company over from her. Mark assumed the reins of LLIS in 2012 after 9 years learning the family business. Low Load Life Insurance is designed not to sell life insurance policies to the general public, but to partner with fee-only financial advisors to get clients the policies they need. So in my business, when I determine with a client how much life insurance they need, I send them to Mark's team, and I know that nobody's going to try to upsell them or sell them too much insurance or talk them out of my recommendation. They're my trusted partner, and I'm pleased that Mark agreed to be interviewed on Profit Boss Radio today. By the way, in Mark's email signature, he describes himself as a husband, father, and hopeful Bucks fan in Tampa, Florida. I assume the Bucks is some sort of sports team, probably football, I don't know. But when I see an email signature like that, I think this guy has charisma. And I think that charisma really comes through in this interview about the sexy topic of life insurance. Please enjoy my conversation with Mark Maurer and stick around afterward for my answers to your questions. But first, my gal pal Erica Mandy of the Newsworthy podcast is back with a financial news update just for you. If you missed her on the show last week, Erica is an award-winning broadcast journalist. She's a former TV news reporter. She's also the founder and host of the Newsworthy podcast. She combines a decade of journalism experience with her own voice and style to provide fast, fair, and fun daily news updates. They're less than 10 minutes long, and she airs episodes Monday through Friday. The Newsworthy is credible and casual. She has an unbiased perspective. So refreshing, right? Hello. An upbeat personality. This is true. She really does have an upbeat personality. She and I palled around at Podcast Movement together, along with a few other ladies, and the smile never left her face. Erica most recently worked for CBS Los Angeles. That's no joke television news, folks. Before quitting to start this one-of-a-kind daily news podcast, The Newsworthy.
Hey, Profit Boss Radio listeners, I'm Erica Mandy, and this is your fast, fair, and fun financial version of The Newsworthy. Would you use the bank of Amazon or Facebook Financial? It could happen. Right now, Bloomberg reports the rules don't allow companies like that to also offer banking services. But a Maine regulator is saying it could be time to change, that maybe commercial companies can do better at banking. And yes, that makes banks very nervous. So stay tuned. It's time to talk salary and how more people are now talking openly about how much they make. The Wall Street Journal cites a new study that found about a third of workers ages 18 to 36 say they feel fine talking pay and promotions with their coworkers, and nearly half say it's okay to talk about it with friends. That's a lot more than other age groups like baby boomers, and it likely means companies will have to adjust to this new way. All right, we're just a few days away from Black Friday and Cyber Monday. Business Insider reports Black Friday might be the best time to buy an iPhone X if you want one, but not necessarily from Apple. The iPhone deals will likely be at places like Walmart, Best Buy, and Amazon. Forbes reports Samsung will also have some great deals to look out for this year. Parents, the hot item for the kiddos is fingerlings, those small robot monkeys that cost about $15. By the way, Black Friday and Cyber Monday aren't actually the biggest shopping days of the year, at least not around the world. Instead, it's Singles Day. Yeah, singles, like the opposite of Valentine's Day. It was on November 11th in China, and CNET reports it brought in more than $25 billion in one day. And that's it for now. The Newsworthy is all the day's news in less than 10 minutes, and it's always unbiased. So try it out at thenewsworthy.com or subscribe wherever you listen to podcasts. And don't forget, there's a special offer available just to Profit Boss Radio listeners. Sign up at thenewsworthy.com to get episodes by email, and you'll be entered for a chance to win a free ticket to Hillary's Profit Boss Live workshop. Just sign up at thenewsworthy.com and let me know you heard about it on Profit Boss Radio. The winner will be announced on December 12th.
I love that. So if you're thinking about coming to Profit Boss Live, Erica might be your ticket. And if you're like me and you want to stay in the know, but you could do without all the drama, check out the Newsworthy podcast in your podcast player today. Mark, welcome to Profit Boss Radio.
Thank you.
Yeah, I'm excited. I get a lot of questions on this topic. And as you know, it's something that, if you need it, if you're in a position where you need life insurance, it makes a huge difference for people. So I think it's meaningful work. And, we've got lots of questions from people. So I'll just kind of get started here. So Can you give us the high level, talk to me about the major categories of life insurance products and give me a little bit of a synopsis of what people should know about those products?
Sure. The two main types are term insurance and permanent insurance. In either of those categories, you have different flavors. And so for term insurance, you have a level premium term policy, which is going to have the exact same level premium for a specified number of years, maybe 10, 15, all the way out to 30. One company even has a 35-year level term policy. And you have term plans that increase every year. They're called annual renewing term, yearly renewing term. But those policies are sometimes start off with a lower premium initially for the first year or two, but then the premiums increase every year. And so those are the two types of term insurance, and term insurance is designed for just that, a term, a period of time. And so we have things like a term in school. There's a start and there's an end. So term insurance is good for things that have a definitive or as close as we can end date, when our mortgage is going to be paid off, when the kids are out of the house or out of college, my retirement age. And then the other type of life insurance is permanent life insurance. And so these are policies that are designed to be around as long as we are. So they don't just sort of stop after 20 or 30 years. Within that, there's lots of different variations. There's whole life insurance that has a fixed premium. There's universal life, where you can design your premium or how much you're paying. Even within those subsets, you can have the cash values tied to other policies that have a cash value, so they build a cash value over time. And you can choose to have those tied to long-term debt instruments. Usually those are called fixed policies, or variable policies. So even you can say, I want my cash values to be invested in different mutual fund lookalikes. And so my cash values go up and down as the market does. There's a lot more variations on the permanent life insurance side than the term, where there's normally two.
So good. And this is one of the most frequent questions that I get. And so let's back up just one step, because who should actually buy life insurance? What's it actually good for?
Life insurance is good for a few things. And I think I have sort of probably, I'm guessing three. One is you should only have life insurance if there's a financial loss at your death. So that means pretty much anybody who is working and has dependents should have some sort of life insurance. Because if I had dependents and I'm not working, well, then I'm basically retired or financially self-sustaining. And so there's not a loss if I pass away. If I have no dependents and maybe I'm working or I'm not, then is there a loss at my death? Sometimes we'll see young people who get their first job and are sold a whole life policy, but they don't have a spouse, they don't have kids. There's no quote unquote loss at their death. So why are they paying for life insurance?
There's no
nobody
risk to insure.
Right. Nobody has a loss. They might want to leave it to their parents, and that's nice, but there's not really a loss.
Mm-hmm. And I have seen that because, and some salespeople also convince young people, oh, well, you're young and healthy now, you should get life insurance while you can, because what if you're diagnosed with something, then you won't be able to be insured. What do you think of that?
Mm-hmm. I can go either way on that argument. I'd say that's true. The likelihood of somebody truly becoming uninsurable in their young age is relatively small.
Right.
But it's true. I still wouldn't then lock somebody into whole life. You can have the same argument with a term policy that down the road you could trade for permanent coverage if you wanted to.
Sure. Okay. So who should buy permanent insurance?
Permanent insurance is a little bit different in that permanent insurance is for, a lot of times it can be more of a want. If you have young children and they're dependent on you, it doesn't really matter what type of life insurance you have. We can talk about what we think is appropriate, but you need to have life insurance because if my kids are 8 and 10, if I died tomorrow, there's years of lost income. There's a real loss to my family. Whether it's $1 million of whole life or $1 million of term, it doesn't matter. My family gets $1 million. Permanent insurance is then for life insurance past a specific need, like retirement age, getting the mortgage paid off. So there's a few reasons you might need permanent insurance. One is a desire to leave something to somebody. And a lot of the things that I read, and especially with some of the new tax bills, we'll hear about estate taxes. Well, that doesn't necessarily apply to a lot of people. So instead of estate tax planning, which I think gets a lot of press, everybody has estate planning, which is just how do I want to leave what I have to whomever. Mm-hmm. And so with permanent life insurance, it can be a way to say, I want to leave $250,000 to my kids. Mm-hmm. We can argue that it's a need, whether that's a need or a want, but that's one reason somebody might want permanent insurance is to leave a legacy.
Okay, well, let's take that number. Let's take that $250,000 number and say Joe and Sally want to leave $250,000 to their kids, and they're 45 years old when they buy the permanent insurance. And how much are they going to spend in premium dollars over the 40 years that they're likely to live?
A lot less than the $250,000.
Is it?
Yeah.
And is that because most people don't complete the payments, so the pool of money on the insurance, on the insurer's side, stays large enough to pay out those death benefits?
Well, there's a lot of things that go into that. One is that the insurance company is taking those premiums and investing it. Mm-hmm. So as long as there's positive earnings, they're going to be able to take dollars today and fund that insurance down the road. Mm-hmm. We're also assuming this person is healthy, and so they're in better than average health. People who aren't healthy then pay higher premiums and may not expect to have as good of a rate of return out 40 or 50 years. And the other thing is that life insurance has its greatest rate of return in the short term. So if we knew exactly when everybody was going to live or when they were going to die, we'd know what's a good idea or not.
Right.
Investments, assuming positive investments like we've had for however many years, at some point investment earnings will beat life insurance, because life insurance usually ends up being the flat death benefit where investments can grow. Mm-hmm. But you need time to get the investments to grow. So that's why we have the life insurance. If I had a term policy, I'd say, well, and really what I should do is just invest those premiums. But I may need too much time. I don't have time if I die tomorrow to earn that.
Right. So it pays off if Joe and Sally, I think I got those names the same, buy at age 45 and something happens and they pass away at age 50. So at that point, over the 5-year period that they've been paying the premium, well, but I guess that doesn't justify the permanent over the term, but
right. In the short term, it's term. I would agree with you. If the short term need is the need is short term, then term is always going to be a better option.
Mm-hmm. So would Joe and Sally why would they consider permanent insurance?
They want to leave something to somebody, so they want to leave a legacy to their kids. So another reason for permanent insurance is that someone has a special needs child. Mm-hmm. Again, I have a lot of term. My kids are 8 and 10, but I expect that, they are going to get out of the house and go to college and do those sorts of things. Mm-hmm. Some people don't have children who can do that. And so my need to be able to have a dependent doesn't end when they turn 18 or 22 or 25. I have a dependent indefinitely and who has a life expectancy that's longer than mine. So you may use permanent life insurance for special needs planning where mom and dad or one combination is caring for a child, but then when they're gone, who's going to be able to care for that child? And then the life insurance provides funding to be able to do that.
And then so what would happen is the permanent insurance would pay the death penalty and it would likely fund a special needs trust, which would then pay for the care and maintenance for this person who is maybe mentally handicapped or disabled.
Right. And so let's say that there's a sibling who may be able to care but doesn't have the financial wherewithal to all of a sudden be able to care for their sibling. The parents set up the funding that goes into this trust, and so that sibling can maybe add an additional room onto their house, maybe move, do things so that they have the funding to care for their brother or sister without actually and being able to use the money from the trust for it.
Perfect. And then just to be clear, is there a difference between permanent insurance and whole life? Is that the same thing?
Whole life is a version of permanent insurance.
Okay.
So with permanent insurance, you can have whole life, you can have universal life, you can have variable whole life or variable universal life. There's lots of different variations on permanent insurance.
And are the distinctions between those flavors of permanent insurance important, you think, to the ordinary investor, the ordinary client? I mean, is that something that for example, one of your employees could educate people on if it were appropriate for them, or
Sure. The whole life is the biggest difference is whole life is a fixed premium contract.
Okay.
If I say I want $1 million policy, the insurance company says the premium is going to be $10,000 a year. Mm-hmm. With universal life, it's a flexible premium. So I can say I want $1 million policy, and then we can say, how do you want to fund that? I want to have it paid up in 10 years. I want to pay for my lifetime. I want to transfer money from this other policy into this one to help reduce my premiums. So that's the biggest difference, is that whole life is a fixed premium. It's set in stone. Universal life, you can design the premium to how it fits.
Got it. Okay. Let's talk about the most popular question I get on life insurance is, how do I know how much to buy? And also inside that question is, what if my wife or husband doesn't work? Like, how do you account for income discrepancies in, married spouses?
Whew, there's a lot right there.
I
Okay.
know.
So the first thing is how much. So we'll go with an employed spouse, partner, parent, something like that. Mm-hmm. My rule of thumb is 10 times earnings is a minimum.
Okay.
I generally don't count group insurance because we change jobs, and usually you can't take the group with you, or if you can, it's very expensive to port it. So 10 times earnings is my sort of minimum rule of thumb. And then there's calculators everywhere where you can, figure out what it is. The very, very back of the envelope is 10 times income is my minimum, or take a look at how many years of work you have estimated ahead of you times your income, and that sort of gives you your upper bounds.
Okay.
And then usually it's some number in between there that is, good on pricing, or, if you can go through all the different, insurance, how much do I need calculators, and you can say you want to pay to have all of your kids to go to Harvard, and you want to pay for it all yourself. And so you need $8 million of life insurance.
You can have your fantasy life, but you have to die to do it.
Right. But if you're making $30,000 a year, it's not a realistic number. So I tend to look, there's different ones that say, here's, debts, things you'd like to pay for. I look a little bit more as what is my income, because most of us should be doing all the things we want to do within the confines of our income. So they're sort of our lower and upper bounds. And then between that, working with the fee-only financial planner is a good way to help narrow that down.
To get a consultative opinion on it.
Mm-hmm.
No, my husband and I have $2 million each on each other. And I said to him, at some point we'll probably cancel it. Like we'll just be able to self-insure. But, we talked about it and we wanted the life insurance to be able to pay for a full-time childcare, because we have an infant right now.
Mm-hmm.
So yeah, we're largely insuring the next 5 or so years, and then maybe won't need it. But it is a starting point for some people.
Right.
And then what about how to think about non-earning spouses?
Sure. And that's a great question. Insurance companies do realize that while they may not be earning an income outside of the house, to your point, if one of you wasn't there, you'd need to hire a nanny or full-time childcare so that the surviving spouse could continue to earn their income. So most insurance companies, again, back sort of the back of the envelope, will consider dollar for dollar coverage of non-employed spouses as the working spouse has. So if working spouse has $1 million of life insurance, non-working or non-employed spouse, parent, whatever it might be, may be able to also get up to $1 million.
Mm-hmm.
Over and above that, it tends to be about a 50% ratio. If the wife is working and she's a surgeon and is insured for $8 million a year or $8 million, and the father is the stay-at-home parent, probably can't get $4 million on him. There is some sort of levels of reasonableness. But
why is that?
It would be, there's not necessarily a reason, even a full-time nanny for a few years wouldn't cost the family unit $4 million. What is the dollar amount of any of that is probably not necessarily exactly proportional.
So I'm kind of playing devil's advocate here. I think I know the answer, but why wouldn't the life insurance company just sell this doctor and her husband the product that they want? Why can't he get $4 million?
Because you don't want a situation where someone is worth more dead than alive.
Yeah.
And again, to what the very first thing we start talking about, what is the loss? Yes, there's a loss to that family unit. Is it $4 million worth? Probably not.
Right.
But if we can make a case for it, the insurance company is happy to do it. If we can make the argument that there is a $4 million loss, and so as long as we can make that argument or figure out where that, why that was the recommendation, then insurance companies
will consider it.
They want to issue policies. They just need to make sure that the coverage is proportional to the loss.
I got it. Yes, I often meet couples where one spouse is earning more than the other, and almost always the earning spouse has 2x or 3x the amount of life insurance. And sometimes the non-earning spouse has none. And I say to them, this is not about income replacement. This is about what the family is going to face without you there. Mm-hmm. So thanks for helping me make that point. Okay. So what is the application process like? When someone applies for life insurance, what happens?
So once they decide they're ready to move forward, depending on the different variations, the client is going to have to sign application forms. And today there are a number of companies who will take a look at that application and run the client's information through a prescription database. They're going to look at a motor vehicle record report.
What's a prescription database? Like looking for prescriptions to painkillers or something?
Yes. Wow. So anytime you have a prescription filled, not written, but anytime you fill a prescription, it goes into a large database for exactly that. Pain pills. There's a big database to look to see if anybody's been prescribed anything. And most medications are sort of given a red, yellow, or green, like a traffic light. Green is things like allergy medication or cholesterol medication. Your yellows are going to be maybe anxiety medications or blood pressure medications. Your reds are going to be your do not go forward, things for Alzheimer's or more significant things. They're also going to look at the MIB, which is the Medical Insurance Bureau. And this is a shared database, there we go, that insurance companies all subscribe to and agree to. And they run a MIB check to see if anybody's applied for insurance in the last few years. Mm-hmm. They're looking to see, did someone get declined by 3 different insurance companies last year, and now they're trying another insurance company, basically to prevent fraud.
Because basically everyone's trying to now pretend that they're healthier than they are.
Right, and we all believe we're healthier than we are.
Right.
So insurance companies, they're taking that application and they're doing sort of those data checks that they can do pretty easily and cost efficiently. If somebody's young, they aren't on any medications, some insurance companies are saying, we'll go ahead and offer coverage now. That's not the norm. Most insurance companies are also going to want the client to have a paramed exam. And so that's a blood draw, a urine sample. The insurance company is going to take a look at that and see, is there nicotine in your system? You said you were a non-smoker, but is there nicotine in your system?
How many people do you think lie on their life insurance applications?
Lie, I'd go with 2 or 3%.
Oh, okay.
Forget things is much higher than that.
Oh, okay.
And
they don't forget if they smoke or not.
Right, but somebody will say, no, I don't use tobacco or nicotine. Oh, I forgot that sometimes at work I chew nicotine gum when I'm stressed.
So they're doing blood and urine. They're testing for nicotine, probably some of the other illicit drugs. Are they testing for marijuana anymore?
I don't believe most insurance companies are testing for marijuana or THC as a normal business practice now.
Okay.
I won't be too surprised if in the short term insurance companies are.
Well, do people get denied life insurance if they're pot smoker?
So far, we haven't had anybody denied who uses it occasionally.
Okay.
And so as it becomes more prevalent and more regulated, it wasn't too long ago where there weren't stores where you could go buy it. And now I think a lot of people will, if they happen to be in Washington and ever wanted to try it, they're going into stores where it's actually controlled and clean and, are trying it.
We're like that in California here too. So there's dispensaries down the street.
Exactly. So if I ever wanted to try it, I would go to there rather than here in Florida. It's not. So I would imagine I'd have to buy it from a friend of a friend of a friend. And, you don't know where it comes from. So I think it's becoming more widespread, but it's also, I think, less of an issue depending. But I digress. We'll see how all of that goes
plays out
down the road. And so you have the application, those online data searches, the paramed exam. The insurance company may also review somebody's medical records. And so they're going to call Dr. Smith's office and request the last 5 years of visit notes. Insurance companies, I'd say, predominantly will order with someone's primary care physician and any ologists. So anybody who's seen an ologist, dermatologist, cardiologist, oncologist, all of those ologists, the insurance company wants to see those because that's a specialist. I've seen something. I've gone to a doctor that's beyond the normal. And so the insurance company will get those records. After all of that, the insurance company then makes an offer. It can be the very best class, super preferred. It can be a standard non-smoker. It can be a standard smoker. There are substandard rates, usually call them table ratings. So if a standard premium is $1,000 a year, a table 1 rate would be $1,250, so 25% higher. Table 2 would be $1,500, so 50% more than the standard rate. We did have somebody decline for life insurance who told us one thing about their marijuana use initially, and then the doctor's record had something, let's just go with different.
More significant.
More frequent. I had never heard the words wake and bake before, but that's what apparently the gist was.
Oh, Mark, you never went to college? Joke. It was a joke.
It's being recorded. No comment.
So this is a lot of work the life insurance company is doing. Is there an application fee?
Right. Nope. So to your point, a lot of insurance companies are trying the idea of that. Can I not do medical records? If somebody's young, there's no prescriptions, can I go ahead and make a preferred offer where if I get their medical records that says, I spend 3 weeks and $100 getting records that say, yes, the client is young, healthy, sees the doctor regularly for a physical and has no medications. They're looking to see, am I really gaining anything by getting those? Or, to save on some of my expenses, can we do this sort of accelerated underwriting?
Right. Well, so maybe stay tuned for that. But in the meantime, all this is going on in the background, and you, the applicant, is just in a kind of waiting to hear. Right.
And so we'll get status updates from the insurance company. Paramed exam completed. Dr. Smith's orders records today. So, like you said, the applicant does a lot of work up front. They sign all the forms. They have to have the paramed exam. They give some blood, they give some urine. And then after that, it's all sort of going on in the background.
Okay. And then when the offer is made, is it a range of policy values, or is it just kind of like, this is what we're offering you, this is the price?
Right. So it will come back, and the insurance company will say, you qualify for our super preferred rate class because you applied for $1 million of 20-year term at preferred. I say super preferred. At super preferred rates, the premium is $375 a year. Okay. Would you like to accept that? Sometimes what will happen is somebody will come back at, let's say, standard plus. So like the third best rate because no one knew their triglycerides were really elevated. So what we can do, and we have this conversation with the clients, with the fee-only advisors, is to say, you applied for the $1 million 20-year term. We thought the rate was going to be $400. Because your cholesterol was so high, it's actually $500. So we have some options. Would you like to accept the policy as we applied, and the new premium will be $500? Or if we do $800,000 instead of $1 million, the premium is $400 a year. So should we have it issued for the same amounts with the higher premium, or maybe let's reduce the death benefit a little bit to get the premium if that's what we were trying to get, just to make sure you have the coverage. And then we'll follow back up with you in a year. Maybe the client will then be on cholesterol medications and have great cholesterol, and we can reapply to either the same insurance company, a different insurance company, and see if we can get them re-underwritten at super preferred a year later.
Okay. So if you get underwritten for a health condition that improves, you can actually improve your life insurance rates as well.
Yes. And sometimes people will get there's things that we can control and there's things that we can't. So cholesterol is one thing. You can take a medication, change your diet, and actually improve it. Some things like family history, most insurance companies ask, have you had a parent die of heart disease before age 60? And if you say yes, I don't think any insurance company will give you their very best rate because you have that family history. Even though I'm in great health, over hundreds of years of life insurance studies and claims and linking things. If someone has a family member die of heart disease before age 60, no matter what kind of shape I'm in, I'm more likely to do it than the person next to me who didn't. So sometimes with family history, there are things that we can't change, but we work with about, I think, 15, maybe 20 different term insurance companies, because depending on what those things are, each insurance company is going to have different levels or limits. Some companies will give that person a preferred rate, maybe not super preferred. So that's the second best rate. Some companies may say, so some things like that, yes, if it's within our power to change and we can show and document improvement, insurance companies are happy to re-underwrite. When you have those things that you can't change, it's important to make sure that whoever was looking at the life insurance looked at a bunch of different options, because if you only looked at companies who maybe consider that person standard plus because of their family history, there's other companies out there that could have a lower premium.
Understood. And so the major categories of things people can do to keep their life insurance possibilities at high and rates low are, I imagine, the standard health recommendations.
Yep. Eat,
Don't
exercise,
smoke, exercise, drink your water.
Drink your water, eat fruits and veggies, no smoking, chewing tobacco. As an example, though, occasional cigars are okay. Most insurance companies say if you have 4 or 6 cigars a year, we're not really considering you a smoker.
Okay, good to know. Mark, what kind of insurance do you have?
I have term insurance because my kids are 8 and 10. I also do have some permanent insurance because I want to make sure I leave a legacy to my kids, and I'm an insurance person, so I think life insurance is a great way to do it. It passes by contract, so it passes outside of my probate estate. It goes to my kids income tax free or spouse. I'm hoping it's dozens of years before it ever pays off. So.
Exactly.
And it's just a great way that I can set that up now. The nice thing about having that insurance is that if, let's say at some point down the line, I say I want to leave my kids $500,000. If that's in my estate, if I have my overall portfolio, I'm going to look at my assets and spend accordingly to make sure I leave them enough. If I use the life insurance and I say I want to leave my kids $500,000, I can use everything. I have some of both. I also have disability insurance because I am the only employed spouse. So my family needs my income. If I'm deceased, there's the life insurance to pay for it. If I become disabled and can't work, then I have the disability policies to pay me an income if I'm alive but can't work.
Perfect. My last question, just back of the envelope, if we take a standard permanent policy, say a whole life policy versus a term for the same death benefit, what would you ballpark is the delta in premium? So how much more are people going to pay if they want permanent versus term?
It's tricky because it's kind of like comparing the fuel efficiency on a Humvee to a Prius. So if I have $1 million term policy, the biggest issue is because the whole life is designed to be around as long as I am, where the term we hope we outlive.
Yeah.
So a term policy, I'll using your 45-year-old $1 million 20-year term policy, getting someone to hopeful retirement age, I'm guessing that premium is going to be 20 to 25% what a whole life premium would be.
Got it. That's a good back of the envelope number.
Yeah.
All right.
But yeah, the hope is that I have that $1 million of 20-year term and never need it, where the whole life should be funded that it will pay off.
Exactly. Mark, you've been extremely generous with your time and your wisdom. I really appreciate it. We'll make sure to put links to your company in the show notes, and let me know if there's ever anything I can do for you.
Well, thank you. It was fun, and hopefully you'll have me back because people ask so many more questions about this.
Life Insurance 201.
or they'll just say, Mark confused the heck out of me all kinds of different ways. Can we do that again?
I think you did good. Thank you. See, wasn't that fun? Mark has a cool way of making life insurance almost seem fun. And now for my answers to your life insurance questions. These are all straight from the Profit Boss Facebook group. Our private community in Facebook has really been humming recently. And if you haven't checked it out, you should come over today. Just go to hillaryhendershot.com/profitboss. And that redirects you to the place where you can apply for membership there. There are some awesome and really valuable conversations happening in there now, including whether or not to get started with a Roth IRA at Vanguard, why most coaches and consultants should charge $500 an hour and how to get there mentally, and how to avoid holiday debt regret. Check it out at hillaryhendershot.com/profitboss. Okay, first question from the group. What are the pros and cons of life insurance in your 20s versus 30s? Is it a necessary expense? Answer. Okay, so you heard Mark and I talk about the kinds of people who should buy life insurance. And if you need life insurance, then in my opinion, hell yes, it's a necessary expense. You get it cheapest by buying it young. So if you buy it in your 20s, it's going to be cheaper than if you buy it in your 30s, but like not by that much. So buy life insurance when you have kids or when you have an insurable need. My policy was issued at my age 36. I was rated super preferred, which means I was in the pinnacle of health. It's like having an 800 FICO score for health insurance, and my premium amount, or life insurance, and my premium amount for 20-year term and a $2 million policy is $87.30 a month. Now, this is interesting, but my policy was actually issued to my parents when I was working for their firm. I was their business continuation plan, so this was issued at what's called a key man policy. Essentially, there was great risk to them that if I died, they had put lots of resources and time and money into training me, and then they'd be sort of up a creek and they wouldn't be able to retire as they had planned to. So it was issued as a key man policy. And then when I left to start the firm I own now, they no longer had an insurable need. So I took over ownership of the policy by informing the insurer, in this case, Genworth, and I changed the beneficiary of the policy to my husband. So my husband and I purchased his policy after we got married. So he was in his 50s and his costs about twice what mine costs on a monthly basis. And he was also rated super preferred. So that gives you an anchor to start with. All right, next question. I've heard a lot about convertible policies. What are the pros and cons? Answer. So if you develop or are diagnosed with some deleterious health condition, you probably aren't going to get issued life insurance. So let's say when you're 25, you buy a 20-year term policy because you have kids. Fast forward 17 years, now you're 42 years old, you're 3 years away from your policy expiring, and you find yourself, surprise, A, pregnant, and B, diagnosed with a serious heart condition. So now you need the life insurance because you're going to have another baby, but you don't qualify for it. By the way, I'm not even discussing the fact that you're now having a baby at the age of 42 or 43, okay? I'm just telling you what a convertible policy is good for, okay? So now you need the life insurance because you're going to have another baby, but you don't qualify for it. Or maybe the rates are just going to really skyrocket. So in this case, if you had purchased a convertible policy, you can convert it to a whole life policy at the end of the term. And whole life policies are more expensive than term, so you're either going to have to pay more or get less, but you can convert the policy to whole life without having to take a medical exam. The downside of convertible insurance is that it's more expensive. You're paying for the option. Okay, next question. What are the differences between term and whole life? Answer. So Mark and I covered a lot of this, but term policies are for a specific number of years, typically 10, 20, or 30 years. Whereas permanent policies are permanent as long as you pay your premiums. And by the way, they are serious about getting those premiums paid. You do get a grace period if you're late, but this is not a credit card company. You cannot build up a balance. One of the most common big mistakes with life insurance is forgetting to pay the premium and letting the policy lapse. This happens a lot, so set it up on auto pay and make darn sure when you move, you update the address with your carrier. You set a calendar reminder, get it done, okay? So the idea is a term policy gets paid if you die during the coverage period, and permanent or whole life insurance is designed to be kept in force until you die. I will tell you that in my 17 years in this business, I have seen one person die with a permanent policy in place. The vast majority of policy owners, for cost reasons or family reasons or, preference reasons, they let their policy lapse before they die, which means they wasted a lot of premium dollars. There is no other component to term life insurance besides the insurance, whereas a whole life policy builds up a small underlying balance. You can borrow from that balance, although you really don't want to be in the position of having to do that. It's sort of like borrowing from your 401k, but kind of worse in my opinion. By the way, life insurance proceeds, whether term or whole, are always tax-free to the beneficiary. And you really need to make sure you remember to do an annual beneficiary check on all retirement accounts and life insurance policies. I think I've told a story before on this podcast about this person I know who got divorced and her ex remarried, had another baby, got in a car crash, died. And he had not reviewed the beneficiaries on his life insurance, and she, the ex-wife, actually got paid. So it's a pretty big deal. Getting back to comparing whole life to term life, and I want to address specifically this idea that whole life builds up value over time. I do think this feature is far overvalued by most people. You're likely only going to earn 1% to 3% per year on the cash value. So the question really becomes, can you reach your retirement goals at the rate of 1% to 3% growth every year? And for most people, that's an absolute no. So that's a pretty good comparison of the two kinds of policies. I can't see any reason to consider a whole life policy unless you need or want and intend to pay to have that policy in force at your death. Next question. Do you think life insurance should be used as an investment vehicle or just go straight term? Answer. No, I do not think life insurance should be used as an investment vehicle at all, as previously explained. Question. If you're a high risk or have pre-existing conditions, what's the best product for you? I'm a mom with previous condition of breast cancer. I get a basic 1 times my annual salary through work. I believe it's a basic benefit they offer to all employees that cannot be denied. There is an option to get more, up to 5 times your salary, I think. But when I try to apply for more coverage through the same insurer, they always deny me based on the medical questionnaire they ask me to fill out. Answer. Yeah, that is a tough situation. I am not sure how I feel about leaning on life insurance provided by your employer because employment is temporary and you can't always take those policies with you when you leave. So you need your own life insurance policy outside your employer. If you have a pre-existing condition, you might consider finding an independent agent who can provide quotes from a few different companies and who know which companies might be willing to consider your medical history. If you can continue your existing coverage when you leave your current employer, do that. This is another reason to get life insurance at a young age because you can get insured before certain medical conditions would make it expensive or out of reach. Also, remember, Social Security does offer survivor benefits for minor children, so there's at least something there for you. I know a 10-year-old boy whose father actually horribly committed suicide, and this little boy gets about $1,000 a month from Social Security because of his father's work history, so that's there. Question. How much should I expect to pay? Let's say I'd like a $2 million policy to my heirs at my death. Answer. So it depends. I did share with you how much my husband and I are paying, but your price is a function of how long the term of the policy is, how old you are when you apply, and your health risks. Generally speaking, the more you purchase, the cheaper it gets for the next marginal or additional amount of coverage. The price per $100,000 of coverage goes down at different levels. I'm going to include a link to an article on NerdWallet in the show notes at hillaryhendershot.com/85. Guys, for a lot of these comparisons, how much should you expect to pay for life insurance? What's the best credit card company? Highest interest rate savings account? Any question like this, I use NerdWallet. They've got quite a resource of knowledge there. And so I want to refer you there. I've put it this way. I've never featured a NerdWallet article in the Profit Boss Weekly where I basically usually tear up the financial news media. NerdWallet seems pretty credible. So I like that site for basic information like this, factual information, okay? Also, you should know that insurance rates are highly regulated. I don't think most people know this. Insurers have to submit their pricing to their respective state insurance commissioners before they're ever allowed to offer them because the government is protecting you against a scenario where you'd purchase a policy, let's say it's a discounted policy and it turns out the company discounted the price to get your business, but now they're not collecting enough premium amount and they go out of business. Now you've lost all that money and maybe you can't get reinsured, or maybe you die and your heirs never get paid. So the government regulates all of that really closely. And, you do want to make sure that you're purchasing from a AAA rated insurer. I wouldn't worry too much that rates between insurers for various policy coverage amounts are going to vary a lot. In other words, you don't have to spend a ton of time price shopping. They all pretty much cost the same within a small range. Also, I believe there is not a premium added to the price of your policy if you work with an agent versus buying it on your own on the internet, like just applying on some website and never speaking to a human being. I think it's okay to use an agent to do that. And I'm pretty sure you don't pay more. I'm 98% sure that's true. Question: what's the best place for me to shop for life insurance? Is there an online portal or a broker? Is there a comparison site? Answer: so one option is to go to nextdoor.com if you use nextdoor.com and just ask people for their favorite life insurance agent's name. Another resource for you is Mark Maurer generously offered his firm's services. So you would need to go to the low load life insurance link in my show notes at profitboss.com/85. Click on the get a quote link, put my name as your financial advisor and my company name. That this is not, I won't see it. You just don't share the information with me, okay? I have no access to your life insurance application, okay? But, just be aware that his firm is set up to work with fee-only advisors like me. So typically when the advisor makes that introduction, the client has a specific recommended policy type and dollar amount. So you'll need to go into that with some kind of certainty about what you want. I will also put a link to a NerdWallet comparison in the show notes. Question: how do you determine how much life insurance you need? Answer: well, you heard me and Mark discuss this a little. It's science and art, but think about these questions. How much will it take to pay off your mortgage and your debt? How much will a funeral and a burial cost? What about college for the kids? Do you want to completely fund that in the case of your death? Do you want to replace your annual income for your spouse? If so, for how many years? Will your spouse have to take time off if you die? And will he or she need money to live on? Or will they need to pay for childcare? Do you own a business that will need cash to operate if you aren't there to run it? If you want a quick answer for most families, I think that 10 times the salary of the highest compensated spouse is a good starting point for families with kids and moderate savings. So that's kind of a general rule of thumb. Question: long-term care insurance. Is it too late for my parents to get long-term care insurance? They just turned 65. Answer: since Obamacare passed, everything health-related has been getting so much more expensive, long-term care insurance included. It used to be that you could still get reasonable pricing in your mid-50s, but now I'm starting to say to people that it prices itself out in your early 50s. So yeah, 65 is probably too old to be affordable. Unfortunately, the cost of healthcare is skyrocketing, you guys, and it's our job to stay healthy. So stay out of the healthcare system, be safe, wear your seatbelt, maybe don't go rock climbing, and save a lot of money so that we can pay for our lives and our healthcare. Well, and if we're not paying for healthcare directly, then our taxes are just going to go up. So it's like 6 of one, half dozen the other. That's just the truth of it. Question: is it too early for long-term care insurance at age 36? Answer: well, actually, no, but whether you should buy it really depends. You might not know that the Family Caregiver Alliance estimates that 40% of the 13 million people entering long-term care facilities are between the ages of 18 and 64. Of course, you can end up in a long-term care facility because you fall or you get in a car accident. But my question to you is, what's your lifestyle like? Do you jump out of airplanes? Do you rock climb? Do you ride a motorcycle? If you have a high-risk lifestyle, you are infinitely more likely to be severely injured and wind up a quadriplegic. So for those of you who have a high-risk lifestyle, I would recommend you consider buying long-term care insurance now. I took up motorcycle riding for a hot minute. I even owned a bike briefly, but it scared the holy hell out of me, and I sold it. So there you go. I hope you have enjoyed this complete guide to life insurance, and we will see you next week. Thank you for listening to this episode of Profit Boss Radio. If you liked it, share it with an artist or creative that you love. And whether you're a painter or a mathematician, may you have all the freedom and prosperity you want.